Good evening, everyone, and welcome. On behalf of the South African Chamber of Commerce here in Singapore, I'd like to welcome you to this evening's webinar, Financial Immigration Updates and Changes. My name is Michael Booth, and it's my pleasure to be hosting this webinar this evening. We've put in a lot of time and effort into this presentation, so I hope that you find the insights that we've put into this presentation of value and that you enjoy the presentation. So now it's my pleasure to introduce our speaker for this evening. She's joining us all the way from Cape Town this morning. So welcome to Marisca de Bruyn. Marisca is a South African tax technician, a business accountant, and an immigration and non-resident tax specialist. Further to this, Marisca has more than 15 years of experience. She is the co-founder and owner of her own accounting firm, Mint Accounting, and she's highly knowledgeable of the South African Reserve Bank and South African Revenue Services processes and systems. So Marisca, thank you very much for joining us today, and we're looking forward to hearing from you and hearing your presentation. As for who am I, as mentioned earlier, my name is Michael Booth. I'm an associate partner of St. James's Place here in Singapore. And St. James's Place is the platinum sponsor of the South African Chamber in Singapore. My educational background, I studied a Bachelor of Commerce and Financial Planning from Nelson Mandela Metropolitan University and Postgraduate Diploma in Financial Planning Law, University of Free State. Essentially, these qualifications allow me to have an informed opinion on areas of South African taxes, pensions, trusts, and offshore investing. So what have we got in store for you here today? We've got a jam-packed presentation for you consisting of what is financial immigration, why should you do it, tax migration, the consequences of financial immigration and tax migration, what is the cost, what is the process, how long does it take, and the upcoming changes at the beginning of the new year of assessment. What are they, how do they affect you as a South African living abroad? We've also prepared a few questions and we'll be taking questions from the audience. So please, this is an interactive session. Please pop the questions into the chat box and we'll deal with them as we go. So without further ado, we'll start with what is financial immigration. So financial immigration is an exchange control process with the South African Reserve Bank. Once this is finalized, you have immigration status. This does not affect your citizenship, but only your residence, because this is not with the Department of Home Affairs, but rather it's with the South African Reserve Bank. Financial immigration does not change your SARS tax residency status. You need to tax migrate to finalize your SARS affairs. When you do your formal immigration, you place on record all of your South African assets, which is placed under control of the financial institution of your choosing. So essentially, once you do this financial immigration, you've declared all of your assets, you're going to have all of your assets placed into a blocked bank account. This is a bank account which is open for you. All other bank accounts must be closed. So any other bank accounts that you have to close. You can have debit orders on this blocked account. You can also instruct the bank to make payments out of this blocked account or send funds abroad. But it's not a day-to-day transactional account. So you will not have online banking facilities. You will not be able to access an online platform and send and receive money in and out of this account. So unfortunately, you won't be able to do that. So moving on to why should you do financial immigration? I'm just going to pass across on to Marisca now, who can really explain into detail why you should be considering doing this.
So leaving the country does not automatically exempt a South African from declaring and paying tax in South Africa. If you do that, you're actually considered a South African living temporarily abroad until you inform SARS and SARB of your departure. So the taxpayer should inform SARS that they ceased to be a resident and exit tax is payable. I'll talk about the exit tax just now in the next slide. Okay, so if you have taken up residence in another country and are certain that you don't want to return to South Africa, financial immigration could be a good option for you. Financial immigration is not necessary for everyone. I never just meet someone and say you have to do financial immigration, it's very important to speak to an advisor and to establish the best route for you, because it's not, like I said, it's not always necessary, and it could be a costly exercise. So you have to just make sure that it's really something that's necessary for you. The SARB can waive your need to do financial immigration if you have been out of the country for more than 5 years and you don't have South African assets other than an inheritance or an insurance policy. So you would then, instead of going through the whole route of applying for a tax clearance certificate at SARS, you would only go through SARB and they will still give you your approval. If you have immigrated and you have remaining South African assets which you want to cash out and take abroad, this could be done as part of your immigration. So normally, if you're a South African tax resident, you can take funds out of the country by doing a foreign investment tax clearance certificate, but that's up to 10 million, where if you do your immigration and your wealth is more than that, you don't need to get special approval to take that amount out of the country. It can just all be part of your immigration. You may withdraw your retirement annuity before retirement age, which is one of the biggest reasons why people actually conclude their financial immigration. The only downside to this is the higher tax that you pay. So if you withdraw your RA at the age of 55, you will pay at the rates of the first 500,000 would be tax-free. But it's important to also note that that 500,000 is throughout your lifetime. So if you have received any lump sum from, let's say, an employer, that would also form part of the 500,000. So at the age of 55, if you withdraw your RA, then all your lump sum withdrawals will be aggregated, and that will then be calculated at the take off the 500,000, and then it's taxed at 18% to 36%. Where if you do this on financial immigration, you lose that 500,000 and only the first 25,000 Rand of that would be tax-free. And then you are also taxed at 18 to 36% on that. Okay, so then also if you do a financial immigration, you don't have to declare your foreign income of over 1.25 million. So I'm sure that all of you are aware that on the 1st of March 2020, your foreign income is not 100% exempt anymore. We pay tax over 1.25 million. So that falls away with financial immigration. And also it's to give up your tax residency in South Africa. So that would be the 3 benefits of why people do want to do financial immigration.
Marisca, I think that summarizes it really nicely why people should be doing this, and also just noting that it's not necessary for everyone. People who are abroad and they can prove that they are ordinarily residents in another country, and also that they don't have assets back in South Africa, they could break tax residency without doing financial immigration. Would you say that's correct?
Yes, definitely. And also I would say other reasons why I would advise someone against it is if you don't earn 1.25 million, you don't have to do that. If you don't have an RA that you want to withdraw, it doesn't apply to you either. And also let's say that you do earn more than 1.25 million, but you're in a country where we have a double tax agreement with, then you have the Section 6 quad tax credit available to you. So it's always good then also to do an analysis and to see, okay, what is your tax situation in, for example, Singapore? What is the tax that you paid there? And then do a calculation. What is the amount over 1.25 million? What tax did you pay on it in the other country? And would it actually end up in a tax paying situation for you in South Africa? And if none of that applies to you, then you don't have to go through this whole process of doing financial immigration.
Very, very good. So if we just put that quite simply, part of the process is, for example, us all living in Singapore, we have a double tax agreement in place. And essentially, we have to look at our tax liability, and then we have to offset our tax liability in Singapore against the taxes in South Africa. And if we are still being taxed, financial immigration could potentially be something worthwhile to pursue.
Definitely, yes, because then you don't want to be in a situation where you don't live in a country, but you have to end up paying tax here. So then it would definitely be advisable to do it.
Very good. Okay, cool. That's all for this slide. I think let's move on.
Yes. Okay, so this is the very, very important part of the process, and it's your tax migration. This is actually where you tell SARS that you want to become a non-tax resident or a non-resident taxpayer. So you have your three options of doing it, and it would be your financial immigration through the SARB, and then you can deregister, or breaking tax residency, or becoming ordinarily resident in another country. So I'm going to start with the ordinarily residence test that we have in South Africa, and that means that it's where you end up after your wanderings, after you've traveled the world and you've worked abroad. Where do you plan on retiring one day? Do you plan on coming back to South Africa? Do you have any pension left in South Africa? Do you have your residences, so your properties here? Or maybe you just work in another country and your family is still in South Africa and you send money to support them, then that would mean you're still an ordinarily resident in South Africa, and then you cannot break your tax residency. Unfortunately, then you will have to remain a tax resident, and you'll submit your foreign income in South Africa, and you would hope that your double tax agreement is in place, and also that you are not in a tax paying situation. But if that doesn't apply to you and you actually have become ordinarily resident in another country, then you can break your tax residence in South Africa without doing your financial immigration as well. That would be if you leave the country for 330 full days or consecutive days, then you are deemed to be a non-resident on the day that you left. So if you would leave South Africa today and you stay out for 330 days, then today would be the day you cease to be a resident. And this is also the date on which your exit tax is calculated, which I'll discuss just now. So what it means is you give up your tax residency, but you remain a non-resident taxpayer in South Africa. You don't have to declare your worldwide earnings in SA, only your South African source-based income, as discussed previously. And also, this is a good option to take if you have remaining South African assets, which you don't plan to sell. So if let's say you do financial immigration, the end of our process is to deregister your tax number. But if you have remaining South African assets, we can't deregister your tax number because, of course, you still need to declare that. So then we just change your status to non-resident taxpayer. Okay, so the consequences of financial immigration biggest one is your capital gains tax that you pay, and that is referred to as your exit tax. So when you cease to be a resident, a deemed disposal takes place by which you need to pay capital gains tax on your worldwide assets. So there are exclusions to this, and that is if you have immovable property situated in South Africa, or if you have 20% shares in a permanent establishment in South Africa, so that's in a company in South Africa, or certain equity instruments with your employer. So those three are excluded because non-residents also pay capital gains tax on those assets when they sell it, but everything else they don't. So if you have unit trust or shares or any other asset, or even a property abroad, you'll pay capital gains tax on that when you cease to be a resident. But then in the future, when you sell this off, you don't have to then declare it to SARS again, because non-residents do not pay capital gains tax on any other assets. You will pay capital gains tax in the future when you sell your property or your shares in the company or your equity shares with the employer, the same rates that you would have done if you were a resident.
So, being that this is on worldwide assets, my assets in Singapore per se now, would they be assessed for capital gains tax for when I do this financial immigration?
It will, yes. So that forms part of your total wealth, which is then taxed on your exit from South Africa.
So let's say that if, just based on what you said on the previous slide about the 330 days, if I've been out of the country for that time, would we then say that my date of exit for capital gains would be at the time that I left? If I didn't own the Singapore assets at that time when I left, do I get to avoid the capital gains tax on the Singapore assets?
You do, yes, because you did not own that at the date that you ceased to be a resident. So it's always important to, when somebody leaves, to just get advice from a tax advisor again, and make sure about the things that will happen. So don't buy property before you're sure that you are actually going to make your 330 days. So make sure that that is your plan, and because if you come back after in that 330 days, it all starts over again. So if you have on day 100 bought a property, but you come back after that day 100, you didn't break your tax residency. So yes, but if you do stay the 330 days out and you bought a property on day 100, you don't pay capital gains tax on that.
I think everyone on this call, I hope you paid close attention to that, because that's a very good piece of advice right there. Thank you, Marisca. All right, and then everyone who's sending questions in, please keep them coming. We will address them as we get later on into the presentation.
Okay, so the process that we do is we send an email out with all the requirements and the application forms, and then you would send everything back to us electronically. The client then needs to send the MP336B form originally, as the SARS requires this in wet ink. All the other forms can be electronically, but this is the only form that they do want to see originally. The MP336B form is a very important form in this whole process, because this is the form that you complete where you place all your assets under the control of the bank. So you need to declare any South African assets. If you leave anything out and your financial immigration is finalized, then it becomes very difficult to then take out something out of the country or funds out of the country that wasn't declared. So if you forgot about a bank account or you forgot about a policy that you had, it becomes a little difficult. You'll have to go through the whole process again, send the forms again. So it's very important to complete any assets that you have. And it's also important to first send that form electronically. We submit it to the bank just to make sure that they are happy with everything. Once they give their approval, then we tell the client to courier the documents to us, because that can also work out costly. Once we receive all the documents, we then apply with SARS for your immigration tax clearance PIN. And then this PIN document is handed over to the bank, and then the SARS would give you an approval. Within 24 to 48 hours, we get that approval, and they give it in the form of an ECA letter, which is an exchange control application. And on that letter, that's where they say that you have your immigrant status. After that, your blocked account is opened by the bank that you've used. And then if you have the retirement annuity that you want to withdraw, we also assist with that. So we applied SARS for the tax directive. And then we also do the complete process for you, where we talk to the funds and we request the withdrawal. We also tell them what the bank details are to pay it in, which is the blocked bank account. And then at that stage, you start dealing with your banker and getting them to send the funds abroad. Once again, if you work with currency partners on this level, then you have a lot of control over it, because you speak to your dealer and you can actually book a rate. They've got an option where they can book a rate, and then if you decide that you want your money to be sent over at X rate, then it will just automatically happen. So that process is almost where it ends, but it's not finalized there. The final thing to do, 2 steps left, is your tax submission, your final tax return, which is called your exit tax return, and that actually only happens in the next tax season. I have tried to do it actually before, but I've never been successful. So I've just decided that I always do it the next tax season. So if you do your your financial immigration now and before Feb 2021, then July or August next year would be your final exit tax return. And also then after that, after the return has been assessed by SARS, then we can apply for your tax number deregistration. Or if you have remaining assets in South Africa, we will apply for your non-resident taxpayer status. So the actual financial immigration process up until you are declared a non-resident with SARS, that takes about 3 months, and that includes the whole process of us communicating with you, you sending your documents, applying for everything. And then the actual tax deregistration can take up to 6 months. And this is important to note that it's not 6 months after your immigration is finalized, it's 6 months after your final tax return has been submitted. So sometimes we deal with a client for a year, up to a year and a half, depending on each client's situation. And also that tax registration, as soon as it's submitted, then SARS gives you a status of suspension. So your tax number goes into suspension, but the actual document comes much later in the process.
So, I mean, just seeing the extensive list that goes on here and everything that happens, you can get this done in 3 months. But I mean, if we were to attempt to do it, I'm pretty sure we might make a mistake on the very first step, which is the SARB form. Perhaps we miss a box or something like that. So have you worked with clients who've tried to do this on their own before? And when they've done it, is it in a much longer period or?
Yes, I have dealt with some of those clients, and they always come back actually, just because it's very overwhelming, and clients do find the whole process very overwhelming. It's a lot of forms, it's a lot of institutions that you need to talk to, a lot of rules that need to be followed. So we have a team that fully just works with clients, and they are on email with the clients all the time. So we like guide the clients throughout the process, because it's just such a hard process actually. And then also from the bank side, what I've noticed is that, let's say a client comes to me and they are with FNB or Netbank or ABSA or Standard Bank, I struggle with those financial immigration processes just because the people working at the bank, it's not their speciality. You know, these banks, the major banks, they do day-to-day banks, investing, bonds, those kind of things. But if you work with a bank that actually specializes in this, the process is also much easier. So if I do a process with FNB, it can take up to 6 months actually to get the financial immigration through, just because the people at the bank are not as informed. But if you do it through Currency Partners or Bidvest Bank or Mercury FX, the process is much easier because this is their speciality. They deal with this on a daily basis.
Very good. We've got a few very interesting questions coming through on this topic as well, but we'll get to them in a bit, everyone, so stay with us. So moving on then, in terms of process and fees, timeline, etc.
Okay, so the full process, if you are a family unit, we don't need to apply for husband and wife separately. We do it as a family unit. And it's also very important to add your children to your application, just because if in the future they need to inherit funds from their granny or something like that, then it is very difficult for someone to get the funds abroad if they haven't done their financial immigration, to get the inheritance out. So a family application, if you had to do the full process, which is your immigration tax clearance, if you have your RS that you are withdrawing, if we're doing your final tax return submissions and deregistering, for a full family unit, it's 16,480. And then obviously if some of the fees fall away, then it will reduce. We also need to charge sometimes additional, sometimes there's like if somebody's been out of the country for quite a while and they haven't actually submitted anything with SARS, sometimes the tax number needs to be updated, like with the ID, or the bank details need to be updated, or there's maybe a tax return of 2016 that's outstanding, or just something old. We also assist with that at additional fees to the full process of the financial immigration. So I've discussed the timeline, and all of this is done within the 3 months, 6 months for deregistration after the final tax return.
And for everyone on the call, please also note that I will be emailing you this presentation at the end. So if you don't have a pen and paper on hand to jot down some notes regarding this, you will be getting it in your inbox from me a little bit later, probably tomorrow. So moving on then. What are these changes that we're talking about, Marisca?
Yeah, so it's quite huge in media, I would say, at the moment. And I think there's a lot of fear that's being created. So firstly, in the budget speech of this year, they announced that financial immigration will be phased out. So this entire process that I've just discussed with you, that will be phased out, the SAR process of it. And the reason for it is just, I would think it's putting a lot of burden on the SAR, where they're not really involved with a lot of this process is, I discussed it a lot with some of the intermediaries, that they don't have anything to do with someone's SARS status, so they actually get involved with something that's not really in their interest. So that's being phased out. You will still do your immigration. The thing that we are not sure of, and we are emailing contacts that we know at the SARB who works in the exchange control department, to just find out, will the MP336 document still be needed if somebody immigrates? Because immigration is not falling away, it's just the term financial immigration. So we don't really know yet exactly what's happening. SARB hasn't given out any information about this, and we find it quite strange that it's 4 months running up to that date and they're not giving out any information. We also ask our partners at the bank and they don't know anything. So what actually happens to an immigrant after that part we don't know, but we know financial immigration is falling away. Then also the biggest impact that the immigration phasing out will have is the withdrawal of the retirement annuity funds, because that's the only way to get it out before 55. So the Treasury has a draft bill out, which will, they state that it will allow non-residents to withdraw their retirement annuity if they can prove they've been a non-resident for 3 consecutive years. So the 3 years does not have to start on March 2021. If you already spent 3 or more years out of the country, then you will qualify for the withdrawal, but you must have submitted your tax returns and declared that you were a non-resident. And the way of doing that is by declaring your foreign income, of course. So if you did not declare your non-residency status in your tax returns, then we can open the tax returns and we can declare that to SARS. And all of this is just, it's not passed yet. So everything that I'm saying now is just in the draft format, and anything can change. We're not sure of anything yet, actually. So one thing that has changed, Treasury has met on the 13th of October, and they brought out in the TLAB that the changes relates to retirement annuities, to pension preservation funds and provident preservation funds. But pension funds and provident funds, they remain unchanged. You can withdraw from your pension fund at any time, and a provident fund you can withdraw once in your lifetime, a lump sum before retirement annuity. So, before maturity. So we are waiting for the draft, for the approval, and we are waiting for final news on this. And as soon as I know, I will update you, Michael, so that you can then just send that over to everyone and everyone can stay informed.
That would be great. It's very strange that they are deciding to apply this only to retirement annuities, not pension funds, not provident funds, but retirement annuities specifically. Is there any reason for that in your mind that you can think of?
I think that the rules for a pension fund to withdraw it is anyway, it's not affected by you leaving the country or not. So I think they're just keeping those rules in place, and they need to change it for the ones that fell under the financial immigration. There was an important part of that I wanted to, so what Treasury has said, and obviously lots of people had to go to them with reasons why they can't do this, reasons why they can't phase it out. And one of the reasons that people brought up was that families who move abroad sometimes rely on this money to set up in that country, because our currency is much less than that. So they need the money to set up. And Treasury's response was that this funds was never intended for you to be set up in another country. This funds is intended for you to retire on. And a normal South African remaining in South Africa only get these funds at 55. So that one didn't go down too well. But what they explained is the reason why they want to do it the 3 years that you have to prove that you've been a non-resident is just to make sure that your residency sticks, you know, like you go to that country and you settle into not being, or settle into that country, and you are really, really sure that you are not coming back and that you've settled there, then that's why the 3-year rule really came into effect.
Or that's what they're telling us, really.
Yes.
They're telling us what we can and can't do with our own hard-earned savings, which is interesting as always. Cool. Well, I think we've still got lovely questions coming through, so everyone, please do keep them coming. So just in terms of my own questions, I think a few people might be interested in hearing. What is you've explained briefly the process of the retirement annuities and the higher taxes, etc. Could you just walk us through some of your experience in doing this? I mean, when you work with an Old Mutual or Liberty or an Alan Gray or someone, do you ever have any pushback from the fund saying, no, you can't actually take that money out or anything along those lines?
Yeah, so the biggest problem I would say that we have with the fund houses is that they don't really have trained people who we deal with mostly. I've actually had a meeting with Liberty before just because I was struggling so much. What we do is we ask the client to do an authority withdrawal letter, which authorizes us to deal with the fund on their behalf. But then just because we are dealing with, what Liberty explained to me is that they are call center agents really that answer the emails and answers their calls. So you would have info@Liberty and any queries go there. And then I get responses, but from different people. And it's that I would say is the biggest frustration is just dealing with the people who aren't really trained as well. They sometimes don't even know what an immigration is. So that's the biggest problem. But because we've done it so much, we've also built up connections with some people at the fund houses, which has made it a little easier. We have recently had a few fund houses tell us that we can't do the tax directives, but then we say we always do it. So I would more say the problems we have with these fund houses is with their staff and not really of withdrawing the funds. I don't experience penalties being levied on the funds before it's paid out. It's really just the higher taxes that's levied on this before it is paid out. But we don't have any problems or kickbacks of people withdrawing their RAs.
I think that's very important to note, and something I just included on this slide for everyone. When we talk about the higher taxes, essentially we're talking about withdrawal table. So essentially, you will be classed as withdrawing your funds when you financially immigrate, not retiring from the funds. It's very different. As Marisca explained, if you retire from the funds, the first 500,000 is taxed at 0%, whereas if you're withdrawing, as you can see, the threshold is much lower, and basically they'll be able to take a lot more money off of you. So the next question that we have lined up is, when becoming a non-tax resident, you essentially mentioned there were 3 ways of doing it: financial immigration, breaking tax residency, and becoming an ordinarily resident in another country. If we don't go through financial immigration, is there another way for us to break tax residency?
Yes, so that would be based on your ordinarily resident residence, where that is. If it's in Singapore and you have your primary residence and your family and you're working there and you're building everything there, then that would be your ordinarily residence. And then breaking tax residency is your days that you spend out of the country. So the 330 full days. Something that's also just important to note on this is the other side of our resident physical presence test is, that for someone to become a tax resident in South Africa over a period of 5 years in aggregate, you have to do 915 days and the minimum per year should be 91 days. So even when you break a tax residency, it's got to be counted back. So if you leave 1st of January 2020 and you've done your 330 days out of the country, you still have you're still over 915 days for the past 5 years. So let's say next year, then you come back for 100 days, that could put you back in that process again. So it's very important to always count your days when you come back, and don't come back next year for more than 91 days, because if you come less than 91 days, you don't make the requirement to be a tax resident again. So it's just very important to take a note of the days.
Especially everyone on the call, if you're considering going home to South Africa for Christmas, and if you at some stage get stuck there, what Marisca just explained to you could actually affect your tax resident status with it being beyond your control. So please note. Okay, next question. So as you explained, it can take between 3 to 6 months. Financial immigration can take 3 months and then up to 6 months, including the deregistration. When they are phasing this out, this financial immigration, how do you foresee this timeline? Is it going to increase? Is it, is it once it reaches that cutoff, you can no longer continue? How do you think that's going to work?
Yes, so that's also one of the things one key question that we posed to the SARB. But one thing the Treasury has mentioned is that as long as the SARB has approved your financial immigration by 28 February 2021, you can still after that withdraw your RA. So then we can still apply for the tax directive, we can still liaise with the fund and withdraw the RA. So the process of getting your SARS PIN could take 21 working days, and then to get your SARB approval take 24 to 48 hours. So I would say that if anyone wants to do their financial immigration, cutoff kind of has to be like the 31st of Jan 2021. I don't think that it should run over that. I don't see that we can submit a tax clearance application with SARS on the 20th of Feb. It's not going to finalize. So that is the only problem now, is that no one is really coming out and saying, giving us concrete information about what really to do. So what we've decided is our last date of submission would be 31 Jan.
They just don't give you the answers that you need, do they?
No, they don't. I don't know when they plan on coming out with it. I don't understand why they're keeping it secret up until the last minute.
They're going to blame it on COVID, I bet you. Anyway, next one. Okay, so the next one is really regarding the deregistration of our tax number. I mean, if I leave South Africa and we go through this whole process, we deregister my tax number, what are the benefits of doing that? And if I have to go back to South Africa for any reason and pick up work there again and all that sort of thing, is it difficult to reestablish that tax number with SARS?
No, it's not. So if you come back to South Africa, we can just do a reinstatement of your tax number. It's just important to not come back within the first 5 years after doing your financial immigration, because that could be seen as a failed immigration. And then SARS can actually ask you to submit all your tax returns for that period and your foreign income, obviously. And in some countries that could end up in you paying high taxes. So that's the only negative side to it. But the benefit of deregistering your tax number would be that you don't have to submit any more tax returns in South Africa. If you still remain a tax resident, but just a non-resident taxpayer, then you still need to submit your tax returns annually, but obviously only declare your SA income.
So if you are a non-resident taxpayer, you must still submit a tax return if you have income from South African assets in South Africa or on your
Correct.
South African income. Okay.
Yeah.
Right. Next one. Okay, I think we basically touched on this now. You advised 31st of Jan should be the last day. Okay.
Yes.
All right, so everyone, those were my 5 brief questions I thought everyone would be interested to hear. Now I'm going to just go to our chat here where we've received a good number of questions. The first one, Darren. So if you do not financially immigrate, do you have to provide evidence of not being a tax resident every year?
No, it's not every year. It's sorry, did you say if you do not financially immigrate and you do not?
So if you do not financially immigrate, do I still have to prove non-residence every year?
So if you do not immigrate, then yes, it depends on also what have you done. Have you informed SARS that you have left? If you haven't, then SARS is still seeing you as a tax resident. You have to still annually submit that tax return, and then you'll put in your foreign income, and that's declaring you're a non-resident. But if you've given it up, if you've actually told SARS your status is non-resident and you have that status, then you don't have to declare it again.
So let's just say then the only time that you would as a non-resident, be declaring your income in South Africa again would be for your South African income from your South African assets, rental income, etc.
Correct. Yes.
Okay. Darren, I hope that answers the question. If it doesn't, please just shoot through another one. Nigel, in terms of what you asked, I've actually got a little tax calculation right at the end of this presentation that will explain how they calculate the income tax on this. So we'll come back to that. All right, Steve, you've asked us, how does this apply if you are a beneficiary of a trust? You receive no distributions, but the trust will dissolve when your parents die, and if there is anything, it will be distributed. So I'm clear, Steve, when your parents pass away, then the assets will be distributed. The trust will be dissolved and the assets will be distributed. Okay.
Can I go?
Yeah, please, Marisca.
Okay, so that would mean that you inherit the funds from the trust, right? So there is a section on the MP336 document where you would just list this. You'll list the trust, you'll list that you are going to inherit funds from this trust, and then when those funds are available for removal from the country, then it's already on the record and you can take that funds out without any problems.
Steve, does that answer? Good. All right. Next one. All right. So from Michelle, you say, if you own a property outright with no bonds, how do you register this with a bank? You don't necessarily have to register it with a bank at all, Michelle. But I think later on, you've asked the question here. You've been out of the country for the last 10 years. And you've married a non-South African and he is employed, but I haven't been employed. The only income I have is rental income in South Africa, which I've declared as part of a joint tax return where we reside. So I'm assuming that's where you reside, as in Singapore. I haven't completed any tax returns since I left South Africa, so that would be 10 years ago. Do I need to declare in South Africa this rental income?
Yes, that would be necessary. It could be in your case that your tax number is even deregistered. So if SARS doesn't hear from someone for quite a while, they actually deregister the tax number. And then when you reactivate it again, it could be that SARS is picking up something from 5 years ago. Then they would request of you to submit that tax return. But it is, according to the Income Tax Act, necessary for you to submit your income that you earn in South Africa. If you do earn pay tax on that income in Singapore, that would be a tax credit for you in South Africa. So you won't pay double tax on that income. You'll just declare it to South Africa that you have paid the tax there as well.
I hope that helps. Next question we received is from Marius. Marius says, does a blocked bank account still allow online banking facilities to manage ongoing expenses in South Africa? Unfortunately not. You don't have an online facility for blocked account.
Yeah, you don't have your own access to it, but you do have your dealer, depending on who you chose your blocked account with, but you have your dealer who you can communicate with, and you can pay any amounts from it. You can pay if you need to make payments to your parents or anything in South Africa, the bank can do that on your behalf.
Okay, good to know. And Marius has also asked, does the proposed changes that they've brought forward now, does this mean that you can access your RA without doing financial immigration if you qualify with the 3 consecutive years?
Yes, correct. Then that's the process. So I do feel in some cases it's going to be a little bit easier going forward. I think the fear in the market is just really around the 3 years and the words that's been thrown around of your money has been locked down, that kind of thing. But I think it will be easier actually.
Okay, so it's just a bit of fear mongering. All right. Okay, I operate my property as an Airbnb in South Africa. What is the implication of this? Well, Airbnb, if it generates an income and you are a non-South African tax resident, you will have to pay tax on that income. If you declare it here in Singapore and you pay taxes on it here, then you're going to, you can offset that against the income in South Africa. Is that clear? Cool, Nash. And anyone else got any interesting questions coming through? If not, I've got a brief, I'm mindful we've got 7 minutes left, so we're not going to keep you all night, but I've got a brief tax calculation on the next slide. All right, Steve, thank you for joining us here. All right, so no other questions coming through. Anyone who is still on the call then? Yes, Maurice, you can unmute. Let me get to you and we can get your question out here. Just give me 1 second.
Yeah, thanks. So just on the non-tax residency. So I've got rental property in South Africa, and I've got an RA as well. And so just to avoid being taxed on your global income, are you saying that if you've filed every year and you've ticked the box that you've left South Africa after 3 years, the global income isn't taxed or taxable? Am I understanding that correct?
No, so the 3 years doesn't have anything to do with your foreign income. The 3 years rule is only to withdraw your RA post financial immigration when that is finalized. So if you have broken your tax residency, that's the 334 days. If you've done that and you are not considered an ordinarily resident in South Africa, that's when you don't have to declare your global income in South Africa, or when you've done your financial immigration.
So I'm just having I'm having a hard time understanding when you don't have to declare your global income anymore. So last year, filed taxes, ticked the box, declared my income. So this year, do I do the same thing, or I declare it, but it's not taxable?
So if I can just jump in there, Marius, it's very subjective, right? And what we say to you is not always going to be the case for everyone else on the call. But essentially, we would have to really look through your specific circumstances. Are you considered ordinarily resident in South Africa? Are you considered, by way of physical presence, South African tax resident? If you are not considered South African tax resident by physical presence or by ordinarily resident, which means you do not have your vital interests placed in South Africa. If you can prove that all of your vital interests essentially lie outside of South Africa, and then we can prove that you are non-resident taxpayer, that means you will only pay income tax on your assets in South Africa. So you would have to go through a little bit of an exercise to establish, are you a South African tax resident or are you a non-resident taxpayer? So one shoe doesn't fit everyone. We'll have to essentially go through that test, and you can get a formal tax opinion to help you with that.
Okay. So I guess the question comes down to is, if you believe you qualify for the non-tax resident, and that benefits you because then you don't have to go through the financial immigration process, what's the process of confirming your non-tax residency status? Is that just through the SARS filing?
Yes, so there's on the RAV01 e-filing, this is the part on e-filing where you update your personal details. You'll just inform SARS there that you became a non-resident on the date that you actually left South Africa. So that's the one step. And then immediately you have that status on e-filing of non-resident taxpayer. Then we submit a letter to SARS explaining your situation, saying where you are ordinarily resident, when did you leave, all of that. We submit that to SARS, and then it's the same process as with the deregistration. We sometimes wait 3 months, 6 months, however long, but then they do come back to us and they give a letter, an official letter stating that you are now a non-resident taxpayer of South Africa.
So that's a separate process than financial immigration?
It is, yes. It's a much simpler process. You don't have to go through everything.
Okay.
everyone, I'm sorry if you can hear a terrible noise coming over me. I live close to the airport, and airplanes are flying over my apartment. Sorry about that. So we haven't got any other questions coming through. So I'd just like to quickly just briefly show you an example tax calculation. And on the back of our webinar we had in April, I got a lot of questions regarding how do you actually calculate your, so let's say you are deemed to be a tax resident in South Africa and you're earning an income here in Singapore. How is that going to be taxed? What does that look like? And Nigel, to your question earlier, this is going to answer it. So what I've done is I've just written a little example for you here. So if someone earns 1.75 million Rand a year, then, sorry, let me minimize these things so I can see what's going on. So the first 1.25 million Rand is going to be exempt, okay? And this is the foreign employment income exemption. So that means your 500,000 Rand will be subject to normal tax. And this will be calculated by your income tax tables. So that 500,000 would amount to 125,000. This would be the South African tax liability, gross liability. You can then deduct your rebates. So primary rebate for a person below the age of 65, medical scheme fees. So if you're paying for medical aid, or in Singapore, we call it health insurance, you can deduct that. Your retirement contributions. If you are contributing to a pension or retirement annuity in South Africa, you can deduct that. And then as Marisca was explaining earlier, the foreign tax rebate, which is called Section 6 Quat. This is your foreign taxes that you've paid in Singapore. These can be deducted against your taxes in South Africa. So in this case, you can see the gross tax liability is 125,000 Rand. If you remove the primary rebate, and let's say you don't have health insurance and you don't have retirement annuity, then judging by 8.13% taxes paid in Singapore and an exchange rate of just about 12, your tax liability in Singapore is 142,000. So essentially, you actually cancel out your liability in South Africa. This does not mean that you get in addition for the following year. It's limited to that 125,000. But I hope this gives some clarity as to how you can actually calculate whether or not you will be paying taxes. There's on the Singapore Revenue Service website, the IRS website, there's a nice spreadsheet where you can actually put in your income for the year, and it will spit out how much you can expect to pay in taxes here in Singapore. Now you can take that number and imagine that you can take that all and offset it against your tax liability in South Africa, and that can kind of help you to understand how much you could be on the hook for. Now again, this is not tax advice. It's obviously very different for every single person, and I would urge you to sit down with a tax practitioner, a qualified person such as Marisca back in South Africa, and they can help you to understand whether or not you are on the hook, firstly, and secondly, for how much. Anything you want to add there, Marisca?
No, I think actually you've done a very great calculation there. It does show the difference between what you earn above the 1.75 million. And this is exactly what I meant when I referred to do a tax analysis with a tax advisor and see if you are actually going to be impacted by the tax above the 1.25 million. And this actually shows a great example of when you will not be impacted.
Okay, so Naj, your question has been, how do you convert this to SGD? So essentially, it will be at the exchange rates. Is it the average, Marisca, the average exchange rate for the year, or is it on the day of submission of your tax return?
So it's actually the spot rate of when you earn. So you have to go calculate March, April, May, June, when you earned what was the actual exchange rate on that date.
Lovely. So you actually have to work it out monthly and come up with your own average and then apply it.
Yeah.
So Naj, I can help you do the maths on that. Don't worry. All right, everyone. Well, we've gone over the hour. It's now 7:02. So if you have any other questions, please please bring them in. Feel free to drop me an email. I will be following up by phone and also by email just to answer any further questions that you may have. I'll also be sending you this presentation. And should you want a consultation with Marisca, please do let me know. I'll put you guys in touch. In terms of financial planning while you're here in Singapore, that's essentially what my role is. If you would like to have a discussion about investing offshore, your insurances, understanding your potential tax liability, I can give you a brief rundown of what that could be like. But at the end of the day, I would advise you to speak to a tax advisor in South Africa. Sorry, my dog wants to play. Everyone, thanks very much for tuning in, and have a lovely evening, and I will be in touch. Marisca, thank you for your time.
You're welcome. Thank you for having me.
Thanks, Michael. Thanks, Marisca. On behalf of the Chamber, have a good evening, everybody. Goodbye.
Bye, everyone.
Thanks, Marisca. Cheers.